Perfect. This is a big group. We could field a, I don't know, small intramural basketball team or something. So I'll be more of the quarterback here. But as Mike laid out, the name of this panel is Stablecoin, the killer app. So obviously that meaning has changed a bit in the past week. And we were supposed to have Do Kwon here. He is not available this week. But I'm sure we'll talk a lot about that. But I actually would love for you guys to introduce yourselves and give a little bit of your background, kind of how you got into crypto, but just so people are familiar with what you're doing here. We'll start with Nick, and we'll go down the line, and then we can get into the killer app discussion.
Hi, everyone, and thank you to the Blockworks and Bankless team. I'm Nic Carter, general partner of Castle Island Ventures, stablecoin enthusiast, probably, but only the right kinds of stablecoins. Yeah, I'll keep it brief.
Perfect.
Nice to be here. I'm Joao Reginatto, VP of Product at Circle, stablecoin builder, if you want. I was the product lead for the build-out of USDC, which is the second largest fiat-backed stablecoin these days. And I lead all the product initiatives around stablecoins for Circle today.
Perfect.
Good morning, everyone. My name is Catherine Gu. I'm from Visa, so part of the Visa crypto team. We started back in 2018, actually during a crypto bear market. And I'm the head of the CBDC and protocols. So we're looking at all things around your currencies, as well as protocols that, layer 1, layer 2 solutions that could be important in terms of infrastructure. So very excited to be here.
Hello, I'm Sam. I work on the protocol engineering team. We do smart contracts development for MakerDAO. You may know me as Hexanaut on Twitter.
You have some fans in the audience. Okay, perfect. Well, let's get into it. Nick, I'm going to start with you. I want to do a bit of a post-mortem here.
Should we do other Sam? Should we introduce Sam?
Oh my God, Sam. I didn't okay, hold on. Okay, hold on. I did not realize that Sam was going to be remote. Someone might have told me that, but wow. Sam, sorry. Hello. I looked over and was like, I guess Sam's not coming.
No. Hey, okay. Everyone.
Well, last but not least, you got Sam?
Yeah, so hey, everyone. I'm Sam Kazemian, founder of Frax Finance. Frax is a fractional algorithmic, I guess is a weird word to say these days. Yeah, we've been doing really well and excited to be here through the metaverse.
Love it. Okay, I missed the speakers meeting actually on Friday, so anyway, I'll make sure to get you in the loop here. And all right, but we're going to start with Nick on a postmortem here for Terra, USD, and Luna. Was this a failed idea from the beginning? Walk us through what happened here.
Yeah, it was reckless financial engineering. People think of this as software engineering, but it's financial engineering, right? And I remember calling you a couple months ago and saying, something bad's going to happen, right?
I called Nick, actually, to be like, hold on, can you explain this to me? And yes, exactly.
So it was pretty predictable if you had a little bit of perspective, right? And were at least somewhat familiar with the history of currency pegs. And then also just if you had a little bit of sense and you inspected the mechanism. But not many people were willing to do that because it was really veiled in complexity. And I think, deliberately so. Often crypto people have a habit of making things incredibly opaque and complex so that the relevant people can't investigate and understand the mechanisms. But yeah, a lot of people will say, oh, it's just a matter of getting the right parameters and let's try again and, let's tweak this and that. But, fundamentally, this is a kind of financial alchemy to try and create, a truly under-reserved, stablecoin system that can survive and grow just based on user trust. So, some things are just not worth attempting.
Why do you think there wasn't more skepticism? You, like you mentioned, were probably one of the few that at least said it publicly. Do you feel like there was a sense that people couldn't speak out against this because you had Do Kwon on Twitter and a lot of believers in this project and high-profile investors in this project? Was that part of the issue here?
100%, yeah. There was a sense that you didn't want to offend your industry colleagues, your industry peers who were invested in this. Frankly, and I'll be candid, Do was extremely aggressive with critics. I think everybody who was a high-profile critic, experienced that. And the Terra army, they literally called themselves lunatics.
Yeah.
You know, and so there were enormous disincentives to speak out, and you know, ultimately not that many people did, so the information market didn't clear.
Got it. I'm going to go to Sam, and if you could maybe talk about, on the technical side, your thoughts on Terra and Luna and what happened here.
Yeah, I agree with Nick completely. I mean, people were doing analysis on this. It was completely reckless, and you could see that pretty much from the start. I think this kind of highlights the need for collateralization and why MakerDAO has taken the more conservative approach of over-collateralizing. It doesn't scale quite as quickly, but in the end, the users who are holding DAI can be certain that they can trade it for $1, and that's what's important.
I'd actually be interested to get both of your perspectives on this in terms of what this has done from a reputational risk when it comes to stable coins. Joao, maybe we can get your thoughts on that for USDC. Was there any thought that either from a regulatory standpoint or just from an investor confidence standpoint that this could really be a hit to USDC and other private stablecoins?
Yeah, I think it's very unfortunate for the stablecoin space, right? Because our belief is that the world needs this Uber dollar API that runs on chain, right? We're all trying to build different versions of that. But if you think about it, and the way that we look at something like USDC, it is a platform, right? I think people tend to focus a lot on the bare asset side of a stablecoin, you know, and the end users that hold it and transact. But actually, it's such an important piece of substrate for the industry that you have all these ecosystems and developers and businesses building on top of that. And from that perspective, we feel the responsibility for building a platform that is going to be there for developers and for businesses for the long term. You can't build something that is going to be exploding in a year's time, right? That's super bad for the industry, for the reputation of this kind of instrument. I don't know what complications or impact we're going to have on the regulatory side. I don't think, you know, people have been talking about it, but there's no practical change yet. But I expect this is going to be a little bit of a purple eye for the industry, right? So definitely
yeah, absolutely. Well, Sam, we'll get to you as well. Catherine, you are at Visa, a highly regulated company. I'd love to get your thoughts working on something like this. And will it make it harder for a company like Visa to get into certain stable coins? I wonder what the process is on the company side for Visa in terms of, you know, either using certain stable coins, and walk us through that.
Absolutely. I mean, you know, firstly, we do think that digital currencies will probably have a very lasting impact in terms of how the future of money movements will go and also how financial services will be constructed. And that's why with that premise, we go in with a lot of trying to figure out really interesting use cases. And I think, you know, just thinking about this space in general, Visa's focus is more on the fiat-backed type of digital currency, so that's whether it's in stable coins or, you know, central bank digital currencies. These are the things we want to look at because we want to understand how the different types of future money can be moved on what different rails and how these sort of financial services can then interact and interoperate with one another. So with that in mind, this is how we've been looking at this space. And I think, you know, going back to all the panelists were saying earlier, it's really important to kind of think about how these different projects are being constructed. Of course, we need to have the sort of the safeguards and also the type of standards like set up because that's important for consumers, for retail investors, for institutions, all to have that in mind. So, but you know, we do think that digital currency have a very powerful impact in the future.
Got it. And Sam, there you are. I'd love to get your take on this.
Yeah, believe it or not, I actually do agree with Nick and Sam a lot of what they have to say. But let me actually paint a picture for you guys here. So for people in the audience that aren't familiar with Frax, we're the first project to basically introduce a fractional algorithmic stablecoin. So what that means is, well, part of the supply is backed by hard assets, over collateralized loans, all the good stuff, other stable coins, partly USDC as well as DAI. Part of the supply, actually very small of this, little of the supply right now, around 11%, is algorithmic minted Frax, which means it is, depending on how you want to call it, under collateralized, or the supply is actually stabilized by contractions and expansions. Frax is basically 89% backed right now in real time. Everything's on chain. The dynamic adjustment of the collateral ratio is on chain. And one thing that's important to highlight is I think, as far as I know right now, Frax and DAI are the only decentralized stablecoins at scale, meaning over $1 billion in supply, that haven't broken peg. Frax is the only algorithmic stablecoin that's never broke its peg in its 16 months since launch. I actually agree with a lot of what Nic says, because the whole reason we created Frax, for example, is we agree that you need exogenous collateral. You actually need other collateral that's not this kind of reflexive game of trying to stabilize the supply of the stablecoin to meet exactly demand. Part of the actual supply can be dynamically, algorithmically adjusted. And that's basically the premise of Frax. And so far, after 16 months of growth, the protocol is extremely profitable. It has revenues of 150 million annually, with only a 1.5 billion supply. That's almost like a 10%, give or take, balance sheet return. 20% of Curve's TVL is Frax from the Frax pool, because of how scalable and expansionary, contractionary it is, with even just a small amount of 11% of algorithmic supply. It's a Uniswap top 10 token. A lot of people have heard of Frax, use it for yields. No, we don't have some kind of unsustainable 20%, 30% thing. Frax is integrated in a lot of places. You can farm it, LP it, use it in normal sustainable ways, and it's just sustainable and scalable. So I actually agree with Sam at Maker and Nic, which is part of the reason why we designed Frax the way it is. And actually, having talked to Doe and the Terra guys, and it is really unfortunate event, and I know kind of they're obviously really in like a bad place right now in this whole thing with everyone, and it's terrible, right? There's a lot of wealth wiped out, and it's just an awful event. But the thing I wanted to say is, like, they started understanding this towards the end. Unfortunately, it was I think it was like too late, right? With the whole BTC exogenous asset stuff, they actually saw the Frax model and were saying, this is the right model that we need to go, because there's no way a 0%, signage model from 2014, the original signage shares, for people that are well versed in stablecoin history, right? The original white paper by Robert Sams, and then later, the 3 coin system with basis.
Right.
Those don't work. They don't have any assets on their balance sheet, right? And I think it's really important for everyone to accept that. And I don't think that's a controversial thing to say. But then the next question is, where do we go next? And I think we're all kind of converging on agreeing a lot of these basically sound design decisions.
Sam, is there anything based on what's happened that you've learned from this and said, we've got to change the way we're doing things to make sure that our stablecoin doesn't lose its peg? And I also want to ask you, you mentioned it's profitable. Can you walk us through what that means for stablecoin? How is a stablecoin profitable? How does that work?
Yeah. So the first part, because profitability means stablecoins have assets on their balance sheet. Well, if you have collateral, right, like Frax, not if you don't have collateral, which is the bad idea that I think everyone on this panel completely agrees with. So you can either deploy that collateral to very safe places, or lend it on places like Compound, or with things like Frax, where 11% or a dynamic amount of the supply is expandable algorithmically, so you can actually channel signage to certain places. You can actually LP different places with Frax expansions, get the trading fees from there. You can get yields, for example, from Curve. Since Frax is entirely on-chain, there's absolutely no collateral or any kind of market activity or market makers or anything off-chain. Everything in DeFi is open to Frax for programmatic expansion, contraction, and profitability, basically. And we have a really good way of being able to do that. So that's why we have about a 10% currently return on balance sheet and signage. I think it's a pretty scalable model.
Okay, that's well said. I want to ask you guys too about sort of the yield situation that happened with Terra and Luna. And quick answer, Sam, are you changing anything? Are you going to change even the term algorithmic? Is there anything you've got to pivot
Well,
to here.
it's the term algorithmic is getting to be a loaded term, but I want to actually propose something because I think there's a lot of stuff lost in translation here. I think it's important before people get into discussing semantics or pedantic arguments to keep things quantifiable and scientific. So my own personal definition of algorithmic stablecoin is essentially a decentralized stablecoin where the primary mechanism or one of the mechanisms of stabilization is targeting the exchange rate of the stablecoin, not that it's entirely redeemable, right? And so it looks more like a central bank that issues currency rather than a depository bank that actually needs to redeem on deposits. And so obviously that's interpretable, right? Like you can think, okay, so Frax obviously has 89% hard assets. So that means that those are redeemable at all times. But then it also has like a dynamically adjusted currently at 11% that is stabilized through exchange rate. But I think it's important to have actual definitions, right? So that we can talk about it. So we're not going to change anything other than trying to make Frax safer, explore new collateral. In fact, we're expanding to credit and real world lending, which is another thing that Maker has innovated on and that we really like, and everything is really great with that. So we're looking into that stuff as well. But I think just making the terms very specific is extremely important as we try to advance as an industry.
Got it. Okay, thanks for that, Sam. Other Sam, I'd love to get your take on MakerDAO and DAI, and how that's different from what Sam is describing here, because there are a lot of different ways to sort of build what, from the outside, look like a similar product. Maybe you could walk us through that.
Yeah, sure. So MakerDAO has taken the approach of always being over-collateralized completely. Frax has gone a little bit further up the risk curve in that regard. So they are mostly collateralized, but not completely 100% collateralized. These are just design differences, and I think it's good to have these multiple approaches so people can pick between based on their risk tolerance and scalability and all these types of concerns. So I think it's good to have like these experiments as long as they're run responsibly, and I think that's the key point. I think Frax has done a good job of doing their stuff responsibly, so kudos to them for that. Yeah, so I think that's the main difference. For us, like our main focus is DAI holders. We want to make sure that they have complete confidence that the DAI peg will never be lost.
Yeah.
They can depend on that, and that's what we're optimizing for. So that is our primary focus.
Got it. And Circle with USDC is fully backed. I guess you could maybe walk us through, Joao, what's different in your model and what you've built.
Our model is super boring, right?
It's probably a good thing, right?
Compared to those things that we're talking about. Our model is very, very simple. It's full collateralization. You know, customers bring $1, we give them $1 USDC, we keep that $1. They bring $1 USDC, we give them back $1. And I was talking to Nic backstage. USDC has actually a lot of churn. Is the stablecoin that by far redeems, is the most redeemable stablecoin. Like in 2021, last year, we have redeemed over $61 billion. We gave $61 billion back to people who are interested in that. Just last week, we were talking about all the movement in the market, right, and high redemptions in some other places. We redeemed over $7 billion just last week. And some people don't understand, but your market cap is growing. How does that work? The thing is, our perspective is a little bit different, as I said. We want to pose questions to the ecosystem. We want to see the next global Venmo being built on top of infrastructures like this. We want to see Robinhood connecting to these things. We want to see businesses making B2B payments, right? They need to connect to this infrastructure, and it's really hard for them to accept something that is not fully collateralized like USDC.
Right, and I want to get Nic's take on this too, but Catherine, for Visa, is it only stablecoins right now that are fully backed? Do you ever see a world where a company like Visa would start using DAI or what Sam was talking about with some different models here? What would it take for a company like Visa to be comfortable with adding or starting to incorporate a stablecoin?
Sure. I think our focus currently, at least, is definitely on the fiat backside, and we're looking at these digital currencies and how they can sort of potentially create very interesting use cases. I think, generally speaking, how we're looking at the stablecoin space. There's the type of stablecoin in which you're managing your collaterals on chain. So things like Maker, Frax, they have all their collaterals on chain. And then you have the USDC of the world, which is managing those collaterals off the chain, i.e. you deposit the money in the bank. And the way I think we're looking at it, for sure, I think by now it's pretty clear not every single stablecoin project is created equally. And when that name comes, which is stablecoin, I think we need to understand what is the risk profiles associated with it. And I think we can associate that all the way back to the 2008 crisis. If anything, even the safest asset can have risk. And that's something I think going to be true forever, right? In the sense, there could be systemic risk in even the safest AAA-backed mortgage. So when it comes to stablecoins, we also want to understand what are the kind of, again, going back to the earlier point, which is what are the sort of safeguards and what are the standards or auditing, the best practices involved, especially when it comes to this reserve management. Because I think the core, as with every protocol project, is that we want to make sure that when a user wants to redeem at par, they're able to do that at any moment given time. So there's a huge sort of, I think, education also that needed to be done in terms of understanding the risk profile associated with each type of stablecoin or central bank digital currencies as such. And I would say, the way we've been thinking about it is, one, how is that reserve being managed? Second, what is that risk models? Well, who's doing the risk testing? How do you stress test the system? And the third is, how do people with different protocols can respond when there's a crisis come along, in the sense, what is your liquidity management going to look like? If there's an emergency oracle system kind of embedded in the protocols, well, how does, say, the decentralized governance and the community response to such thing? I think these are super interesting things for us to learn.
Got it. And Nic, I want to go back to you on this. Crypto markets are going through sort of a stress test right now. A lot of these projects have not been through a bear market, a crypto winter, if you will. Do you have any sense that there are things other than Luna and UST that won't work based on the downturn in prices in the moment that we're in right now?
I mean, Luna Terra was clearly the largest ticking time bomb, certainly the most fragile project. It was clear that the anchor yields were subsidized, and once that subsidy ended, that's how I thought it would fold up. Mm-hmm. There would be outflows and redemptions, and they wouldn't be able to stabilize the peg against that backdrop. But you're right. I mean, the whole thing could well have been catalyzed by the fact that Luna was selling off alongside general tightening in risk markets. And this is a new regime we're entering now. As an industry, crypto has always existed against the backdrop of liquidity and loose financial conditions. And the crypto industry has never seen a recession, right? In the general sort of macro context. So now that we have this tightening, which appears to potentially continue for a number of quarters, it will expose a lot of these bad ideas. And that's healthy, right? I don't know if I could identify the next Luna, if that's what
out there?
You're looking for.
Yeah.
But yeah, I mean, fundamentally, if you're an under-reserved stablecoin and you are declaring a peg and it's a function of your credibility and your ability to raise capital to defend that peg, you are painting a target on your back. And there will always be adversaries there, and you will be challenged by the market. And major central banks have proven that they couldn't defend themselves fully from the market when they declare a peg. And so, believing that a crypto startup could do what the central bank of Switzerland was unable to do is just reckless.
What about
Can I respond to that?
Yes, absolutely, Sam.
Yeah, so I actually agree with a lot of that. So the reason Frax is actually entirely on-chain, and so the collateral ratio is dynamically adjusted with an algorithm, is, as Nic says, you can't just do a lot of these things and then hope for it to work out and for the best, right? You paint a target on your back. For example, when Frax adjusts this collateral ratio, the fact that it's entirely on-chain allows you to see the actual adoption and confidence of locked liquidity, how much debt is actually denominated in Frax across all lending markets. For example, right now, 11% of the Frax supply is algorithmic, quote, quote, right? And if we were not data-driven and entirely on-chain, for example, you couldn't actually see where things were going, right? There'd be no actually ability to see how much debt is denominated in Aave for lending Frax. There's 9 figures of Frax there. There's a lot of borrowed demand that has to actually be bought back, right? If everyone's trying to redeem that 89% collateral, there's actually debt that has to be repaid. So that's actual demand. You can actually quantify the actual integrations and the actual confidence and the real usage of the stablecoin because it's a deterministic and programmatic system. So then you can actually build a data-driven algorithmic approach to say, okay, we need 95% hard assets, or we need 89% hard assets, or here's the computation we did. Actually, you can run it on an L2 or push it to L1 and actually have that entire thing be on-chain as like an algorithmic CR adjustment. This is actually literally minus the pushing to L1 and stuff we do, but we're actually looking to do even that stuff. But we look at all of this stuff programmatically because we know, as Nic said, you can't just willy-nilly this and then hopefully it actually works. But if you build an entirely on-chain stablecoin, you can make a deterministic system that actually works. In fact, so far, it's been a success.
And you mentioned that it's built on chain. I talked to Do Kwon a couple months ago about this idea, and one of his arguments and points was that it was supposed to be totally divorced from the traditional financial system, so that made it safer. Clearly, there's so much overlap with at least Bitcoin and traditional finance and what's going on with the macro picture. Are any of these projects that are supposed to be totally immune from what's going on in traditional markets, can that ever work? Are there other examples of this? And was that part of the issue, the idea that you thought it was separate, but it really wasn't, and it's tied to all of this macro noise going on? Nic, maybe you take this one.
I'm hopeful. I remain hopeful that we can create, truly decentralized stablecoins based on crypto collateral, with this sort of algorithmic model. Probably over-collateralization is the way to go. But the truth is, we're fully indexed to what's happening out there in the world. Even the fiat convertible stablecoins, right? You're sensitive to the treasury market and the liquidity conditions in treasuries. That's something that we don't discuss very much. I mean, there's even potential liquidity issues with the most robust fiat convertible stablecoins. So those are kind of the gold standard, but even there remain risks. Especially if liquidity breaks down in the treasury market, which is certainly possible. Certainly possible.
It'd be interesting, Sam, to get your take on that.
Can I respond to that?
Yeah.
Yeah, so when you're operating at the scale of billions of dollars, there is just not enough in crypto native assets to sort of build up that supply. We know this now. There was some people doing cool experiments like with Rye. I think it's a worthwhile experiment. But ultimately, I just don't believe it can scale. The only way to do this is to connect into the real world, start bringing on-chain sort of the asset market in the real world, which is like way, way bigger than the crypto market caps, even after this massive growth spurt. So yeah, I think this is the only way forward. I think Sam would agree with me. I mean, they're branching out into real world assets as well. So Maker's been heavily focused on this from the start. And this is really the only way to run a decentralized stablecoin at scale. There's just not that many options when you get up there. And it can still be decentralized in my view. So like, I think some complaints are that if you're building things out of sort of with counterparties and centralized components, it can't be decentralized. I do not agree with this. I believe we can just get decentralization by heavily diversifying the asset classes and jurisdictions and just get a whole big portfolio of a bunch of things where you protect yourself from individual tail risk. This is totally achievable in my view, and this has been Maker's focus from the start.
Yeah, and Joao, I wonder on Circle's side too, to pivot the conversation a little bit, if you want to respond to that, but I also want to get your take on regulation because I know Circle spends a lot of time in DC. Any sense that regulators are going to see the headlines around Luna and what happened with Terra USD and come down harder than they would have otherwise on stablecoin regulation?
Yeah, before I get into that, if I can just respond. No, I don't think it's a counter argument to anything that has been said, but I think sometimes we are getting, especially in the last year or so, we're getting hung up on this idea that, there needs to be a decentralized algorithmic stablecoin. But it feels like we're starting from the solution and trying to then find a use case for that. Obviously, Bitcoin and all these things are amazing innovations and they have super important use cases, but I think what we're focusing on is, can you bring benefit? Can you bring better quality attributes for the financial services that people use today? And yes, decentralized algorithmic stablecoins, they have very clear principles that, theoretically would bring benefits for those users. But actually, what happened in the last 2 weeks, like it also costs a tremendous amount for normal people, right? And we have to be careful. We're trying to do good, and then we do this tremendously harm to people. So to me, the perspective that we have instead is let's build, very solid substrates. Let's build interoperable layers that every financial service, any business can connect to, and transform the user experience that users have today, right? The fact that they can't move their Robinhood balance easily to Revolut in Europe, right? Let's break those barriers. Like we are in 2022. It's about time for us to do that. So I think focusing on the customer problem and focusing on the benefits that we can actually bring to the population around the world and having this massive substrate that everybody can connect to, I think that's the focus, as opposed to, is it this solution or that solution or that solution? I actually think there's space for centralized stablecoins, CBDCs, algo stablecoins, everything.
Yeah.
But on the regulation piece, again, as I said, I don't think we have felt the impact at all of this. I think, the information that I have, I think everybody has reading in the news, the way that Janet Yellen made a statement and mentioned UST on her deposition. I think the UK was announcing some changes with regards to how they see stable coins as well. I honestly think, I want to think that it's going to be positive. I think it's important for us to have regulation, right? Again, what we have seen in the last number of weeks shows that consumer protection is a very important thing for us all to keep in mind. And I hope it's going to end up being positive despite some reaction that we might see.
Got it. And Christine, let's get your take on this. I also want to talk about central bank digital currencies. But what's your take on regulation and what this means?
Yeah, I think to Joao's point, definitely regulators are getting more into this and spending time to really understand, for example, how these mechanism works and therefore what are the safeguards and rails that they should create. So definitely a very important question, important initiative to do. And we spend a lot of time talking with regulators, central banks, just understanding this space in general. And I want to go back to Joao's point because I really agree with what he's saying because with whichever stablecoin project we're looking at, we're trying to derive utility, the trust coming, the value coming out of it. And that utility has to come from the use case in itself. And it's not just, singly for stablecoin alone. I mean, it's the same when we're talking about CBDCs as well. So, in my day-to-day work, I spend a lot of time talking with central banks. And in fact, this core aspect of what exactly are these digital currencies going to be used for is so crucial to understand. And we like to refer to the fact that we've been seeing this massive growth in stablecoin over the past few years. Like last year, we had I think close to $6 trillion of on-chain stablecoin transaction volume. So clearly there's value being made and being moved. And the key is to understand who's driving that and what are we building. And one of the key metric we actually like to track is the size of the developer ecosystem out there in crypto. I think Electric Capital sort of did a study that last year 75% of growth in terms of the number of developers who are building things on top of these open blockchains. And this is great because these are the people who will be staying in the ecosystem even when there's market downturns or upturns, they'll be here to build. And as they're building, we're seeing this growing ecosystem of, say, global fintechs, crypto-native companies who are building the product from the ground up using digital currencies. And we said, I think previously, money is being programmable and the fact that everything can be built on smart contract and these smart contracts are composable, right? So in a way, the beauty of, I guess, digital currencies like stablecoins and CBDCs is that in some way you can allow developers to start building things a lot faster. They're lowering that barrier to entry to start creating a business. And we think, if that utility continues to grow and exponentially growing, then that will be really good. And we're very much leaning into all these future, different ways money moves. So yeah.
Really interesting. We have about 5 minutes left. So I'm going to do sort of a quick around the table here. But I do want to get your take on central bank digital currencies, what that means to the private stablecoin market, and the potential in that space. But maybe we'll start with Sam. 1 minute on the clock. You go
Okay.
ahead.
Sure. Well, one comment from everyone that's already said. So I usually have this saying that's like, all roads lead to Frax, but I actually think after this panel, it's going to have to be like, all roads lead to Frax and Maker, because of just so much similarities we have going. And the thing that I wanted to actually say here is like, you know, we're getting really caught up in like semantic brands, over collateralized or like algorithmic and stuff. And it's not just over collateralization as like a concept. I always say, okay, what if Maker was forked and there was 1,000% over collateralized DAI? Then how come someone doesn't do that, right? It's because if you did that, no one would mint such expensive debt, right? Maker would outcompete it clearly, but everyone would love a 1,000% over collateralized stablecoin, right? But what happens is the market evolves to the right risk-adjusted ratio of scalable currency, right? And so right now, it seems like it's between 89% on chain from what Frax has to 150 or 130, whatever Maker is. But I think it'll converge to what the ideal market's risk-adjusted preferences and scalability. So I'm really interested to see how these designs converge and how everyone works together.
All right, we'll go to Sam for a last word, either CBDCs or if there's something you want to hit that we haven't talked about yet. The floor is yours.
Yeah, I mean, CBDCs, I don't have strong opinions about that. Like, if it comes on chain, like it could potentially be used as collateral. It's just a risk-reward sort of evaluation on our end. So, I mean, I don't have strong opinions on that. I am agreeing with Sam on sort of this converging about where the most optimal risk tolerance is with sort of these stablecoin designs. I think what does set Maker apart is our staying on the conservative side, just to give people sort of the most dependable decentralized stablecoin available. And the beauty of DeFi is that like we can have multiple options. People can choose what they want to use. So I think that's a beautiful thing, and I like the optionality that's there.
Got it. All right. Who's next? Catherine, we'll go down the line.
Sure. So again, I love quoting data, but like this year, so the Bank for International Settlement, they do these sort of regular surveys. So currently, you're looking at 9 out of 10 different countries are actively doing research and experimenting with central bank digital currency. So clearly, there is a momentum from the regulators and the central banks also looking into very similar types of technologies to be. We do think that there's going to be a lot of synergies from what we're learning or what we're seeing already from the growth and the success of stablecoins and how we can move that over while looking at central bank digital currency. In fact, the underlying product infrastructure can support both. And interesting enough, a lot of the central banks these days are actually looking at the future of CBDC. They call it CBDC 2.0, which is how they can interact with the DeFi in the future. So I think these kind of things are very interesting, and it's definitely good to have all these sort of synergies being built. But I think the key around all of these is going to be around interoperability, because outside of the crypto and the blockchain ecosystem, we already have real-time payments, ACH, wire transfers, and now we're going to have new payment rails such as the stablecoin on the blockchain and central bank digital currency. So to enable all these multi-chain, multi-hub, all these kind of multi-dimensional things to interoperate with one another, we have to have solutions that could allow seamless sort of flows to be happening. So,
got it. Joao, your thoughts on also what it means for Circle, for the private market?
I'm maybe a little bit less positive on it. I think there is potentially an application for CBDCs for increased efficiency of that world, within central banks and banks. I do think, though, that central banks they don't come across as the type of organization that would be capable of operating these mechanisms at scale. I mean, Frax, Maker, Circle. It's really complicated to operate an infrastructure like this. And then I think a key piece, which is something that we believe in a lot, which is permissionless, the title of the conference. I mean, we never signed a deal with Maker, right? And Maker utilizes USDC as part of what they do. We never signed a deal with Sam at Frax, and Frax utilizes USDC. It's composable, it's permissionless. I don't know if CBDCs are going to be like that. I suspect there's a huge barrier for that to be the case. And if that's the case, then I think they might play a role more in the back end and for interbank use cases and other things. But I don't see as something that will get scaled in terms of being a bearer instrument that you and I are going to use.
Got it. And we come full circle back to Nic. Last words for the panel, Nic, either on CBDCs or just your thoughts on stablecoins as a killer app.
Yeah, I'll be brief. I mean, stablecoins are clearly an incredible consumer product. Everyone loves them. They're the killer app of crypto so far, no question about that. They've also been responsible for great harms. But ultimately, what is it that people desire? What do they want from stablecoins? They want transactional autonomy. They want, obviously, programmability. They need it to be digital. But you want privacy, right? You want cash that exists in a digital context. No government is going to give that to us. There's no government that will allow us to digitize physical cash. No CBDC plan is sincere about that. So there's no chance that CBDC recaptures the qualities of physical cash in the digital context in a way that actually gives consumers what they want. We have to look to the stablecoin sector for that. And I hope that it can achieve that.
All right. Perfect. Well, everybody, and Sam, remote here. Sam, Catherine, Joao, Nic, thank you all. And thanks, everyone, for tuning in. I know we're live streaming, too, so whoever's watching at home, thank you, guys.